Hello, everyone. Thank you so much for joining us again for our weekly wrap-up. My name is Jeremy Kronemeyer. I'm the Operations Manager for Wickham Financial Group, and I have with us today Graham Wickham, President and CEO of Wickham Financial and Insurance Services. And Graham, tell us what happened in the market last week.
Yeah, thank you, Jeremy. Thanks for our listeners being on the call. We had a pretty modest rise in the S&P last week, hitting 5,000 for the first time. That was up about 1%. We saw a remarkable 14 weeks positive over the last 15 weeks. We also saw the Nasdaq and the Russell also gain about 2%, led by growth stocks, primarily technology, up about 2.8%. We did see utilities and consumer staples off about 1.5% to 2%. And really the real big leader of last week was really crude oil. Those prices shot up about 6%. We did see U.S. Treasury yields jump a good bit as the Federal Reserve, the FOMC, basically in no hurry to cut interest rates, basically still wanting to see the whites of the eyes of that inflation continue to come down closer to their mandate. We did see a pretty good auction for the 10 and 30-year Treasury auction that was out there. That was pretty solid, so that's nice to see the demand at the rates that they're being issued right now. One thing we did see a revision for December 2023's CPI, and that's Consumer Price Index, revised down, which is a positive for the camp that wants inflation to come down, right? All of us. That was 3.3%. But keep in mind, today we had a pretty hot number come out, spooking the market a bit. I'll make a comment, probably a little more detail here in a minute on some of this. But we look at some weaker demand for commercial consumer loans for the fourth quarter of 23. At the same time, we did see an increase in the delinquency rate for credit cards and auto loans for the consumer. Even though they've been resilient, they're spending, maybe they're getting a little bit over their skis, getting back into some old habits, increasing their debt loads, which could end up being a negative depending on how quick, how fast, and how high that goes. We did see the U.S. Treasury deficit saw some of its biggest contraction we've seen in 14 years in 2023 here in the United States. If we kind of go overseas, we're really seeing China authorities looking to do whatever they can to get the equity markets up, to get confidence back up over there. We're still seeing their CPI numbers continue to fall because of the lack of demand. We saw their producer prices tumble about 2.5%. If we go over to Australia, we did see their central banks keeping interest rates steady. Again, they're still concerned about inflation. Maybe it's a bit too high. We go over to Europe or the Eurozone. We're still seeing retail sales falling about 1.1% month over month for December. Germany, stubbornly low. Real challenge to get positive performance in that economy. We're just seeing the industrial production continue to decline. Now this week, it's the Fed, it's economic numbers, it's the chatter going on. Not so much earnings playing a role this week, so we're really at the end, if pretty much out of that period right now. And we saw some pretty decent numbers. But again, I think some of these CPI numbers, especially the one that came out today, quite a bit hotter than expected, pushing the Fed's appetite to lower interest rates off a bit, maybe spooking the market a bit.
Gotcha, Graham. Well, thank you so much. I had a question for you. At these current market levels, what do you see kind of going forward in some general thoughts?
Yeah, I think kind of that latter statement. I think the market got a bit over its skis, pricing in too many rate cuts, maybe assuming that inflation was going to fall quicker, the Fed was going to be more aggressive in cutting rates. And that's just not the case. They need to hold off, ensure, or they want to ensure that inflation's on a consistent path of coming down. We do believe it is, but just not at their 2% mandate yet. So I think the market just has to give back some of the stuff that it gained because it was pricing in a little bit too much perfection with the Fed participating with lower rates. And I think that's a pause, as we've mentioned before, that can refresh It can be an opportunity for anyone's portfolio or someone that's interested in certain areas that they haven't maybe felt like they had an opportunity to get in because maybe it went up too quick, like technology or certain areas like that, or just equities in general. Maybe this is a pause. Maybe ends up being a pullback or eventually a correction that creates an opportunity to add to some of those areas that maybe many felt they missed.
Gotcha. Well, I did want to thank you, Graham. I did want to mention that we do have our retirement planning today classes coming up to people that are on the call. If you or someone you know might be interested in that on A to Z retirement planning, please check out our website at wickhamservices.com or call our office and we can get you more information there. And we look forward to seeing you, and we'll see you next week on the next weekly wrap up.
Take care.